Oh boy. Hey, it's Mike. It is Tuesday, June 2nd. Trying to be as consistent as I can be with these posts. And candidly, we have a baby on the way. So my wife and I are blessed with our third girl due later this month. So I'm gonna try to be as consistent as I can as we walk into that. So if there's a break in this, I apologize. But yeah, just appreciate you taking the time to check out, our show here today and really just want to go through a few things really, because the mortgage market just got weirder. Rates aren't falling and we're seeing, of course, a non-QM movement having kind of a moment, right? For non-QM home loans. And we'll talk about what those are if you're unsure. We've spoken about them a few times now. And of course, we'll go over what's going on with Iran and oil mortgage rates and of course the market adapting again. So really what we're saying is mortgage rates are still hanging around 6.5 to 6.625, right? Remember, interest rates for mortgages generally move on 1/8%. So what does that mean? 6.125, 6.25, 6.375. So we're seeing that, right? We saw a couple years ago when inflation was a giant concern, if you recall, 7.5, and we're not quite there, right? So I know a lot of people are thinking rates should be lower right now or could be lower right now. And instead, the market's dealing with inflation concerns, oil prices, geopolitical uncertainty. But beneath the headlines, something interesting is happening. So remember, we're seeing oil prices surging above $100 a barrel. And that's because of Middle East tensions or tensions in the Middle East, if you will. We saw inflation remaining stubborn as a result, right? We're seeing that GDP, these numbers are coming out. And so it's kind of a give or take. And because things are not so great in some ways with the job sector, ADP jobs reports, and which are GDP numbers, gross domestic product, we are seeing some hindrances in some areas, not allowing that inflationary number to jump to the higher rates that we had, 2, 3 years ago now. So mortgage rates as a result, between I would say 6.25 even to 6.75, depending on the transaction on a conventional loan. That's what we're using, not FHA. FHA, VA, a little bit lower. In fact, VA rates, we priced one out for a buyer who's putting a substantial amount down, perfect credit, 5.625, was an APR of like 5.781, I believe, in that range. So these are ranges, right? So that's my disclaimer. Um, that being said, everybody's asking when rates will drop. We were really fortunate enough to help a lot of our clients out that purchased in the last year or two with our strike rate. And our strike rate watches those rates for them. Then when it comes time to refi, we secure the refinance offering credits because they purchased, right? And they're past clients, they made 6 months payments that, we essentially offer credits to help offset those hard closing costs from the purchase. So the better question that people should be asking is what's preventing them from dropping? Right now, it's inflation, energy, and uncertainty. As a result, this spring market is usually robust. And it was. We had a great first quarter, second quarter. We're super blessed to be where we are this year as a team. And we're seeing that with other branches within the company I work for, American Pacific Mortgage. But the uncertainty is causing a lot of folks to step out on the sidelines. So, what I'd share with anybody before you talk about the next item, which is, straight nobody's talking about non-qualified mortgages, is simply looking at what the market is truly doing for sellers. It's cool to know what's going on the buy side. Trust me, if you're a buyer, I get it, right? Watch it. However, sellers are in a predicament too. They're having to sell in this market. There could be a reason why. There's more properties on the market than usual in most places. Of course, there are those areas that we talked about, like San Francisco and certain niche markets where it's just thriving and multiple offers still. However, throughout most of the state of California and throughout largely the country, we're seeing a softer market, which means sellers are having their properties sit longer, which means there could be opportunities for buyers, seller credits, incentives, getting a down payment assistance transaction, which would not have been approved otherwise approved. And on that note, I do want to kind of plug CalHFA, if I may. They just sent the emails out last week for those that were approved with the Dream for All program for this first round of this year. If it's not used by August, then there's a second wave that goes to those next folks that are in line, right? So keep that in mind. If you're a buyer, here's an opportunity for you. You can refinance later. We've done 39 of them in the last 8 months where rates dipped. We took advantage of it. They were able to capitalize on the savings. It is possible. Okay. So non-qualified mortgages is what I want to talk about. Next part is they're becoming increasingly more competitive. And the reason why is we have something called loan level price adjustments. And that's what we call risk factors. So the higher the loan to value, meaning the higher or the lower the margin between the purchase of the property and the loan amount, right? Or credit or documentation type or whatever it might be, condo, right? If it's condo versus single family home, two unit versus a one unit or whatever it might be, mixed use, they're adjusting that rate for those risk assessors. That's a loan level price adjustments, risk-based pricing. It's actually a disclosure you get when you purchase a home, risk-based pricing. We're finding those bank statement loans are pricing more aggressively. Meaning if you're a self-employed individual and you're using bank statements to qualify, you could actually get a lower rate in most cases than a conventional mortgage. Great to know. The DSCR loans, if you're buying a property and you're looking to invest in a property using the income of that subject property, believe it or not, may price a lot better. Actually, it will price a lot better in most cases than if you're doing a conventional mortgage on a non-owner occupied property, especially if it's a condo. Some scenarios, again, matching conventional, most are actually being better and they're outperforming conventional interest rates, which is so interesting because conventional loan level price adjustments are continuing to punish certain borrowers or buyers. Self-employed buyers may actually have more options and better pricing opportunities than they may realize. 5 years ago, I would have laughed, honestly, if someone said a bank statement loan would be competing with rates of a conventional. I'd be like, no way, that's crazy talk. But here we are. The non-QM world has matured significantly. Why? Well, think about it. Mortgage bonds, mortgage-backed securities, that's a bond. It's going to reflect and follow closely with their 10-year treasury. Check the 10-year treasury today. Check it out. It's higher than it was in the last, I'd say 4 to 5 months, right? We're looking at pricing like where it was last year for these mortgages. That's your Fannie Mae, Freddie Mac mortgage-backed security. So if you look at the non-qualified mortgage, priced differently, using a different index, if you will, or something that's a little bit different than your standard mortgage loan. So what realtors are missing, a lot of buyers think that they don't qualify. Business owners are writing everything off. Investors with multiple properties, right? I can't finance more than 10 properties. It's an age-old thing. We knew that for years, right? They could use a DSCR loan in this case, up to 8 to 10 units, by the way. And they're using things like, bank statement loans, profit and loss loans. We even have a no ratio product, right? And then there's asset depletion for high net worth borrowers. So many people aren't necessarily getting declined. They're just being put in the wrong box, and that's a huge difference. So keep in mind now, buyers are adjusting, as I mentioned earlier in the segment. We're seeing buyers step out. The ones that are staying active are getting their offers accepted. We're seeing seller credits. We're seeing rate buydowns. We're seeing negotiation that's returned between the buyer and seller. This doesn't feel like 2021, and it doesn't definitely feel like 2008 because there's more equity in homes than we've seen in years. It feels like the market's learning how to function at higher rates. And if you look at a 40-year comparison, I kid you not, I've posted about this, I've written about this. There's articles that have been published about this that I put together. The average rate in the last 40 years is between 6 to 6.5. Well, I hate to say it, we're right there. Just people got used to this thing that the Federal Reserve was doing called quantitative easing and buying bonds and mortgage-backed securities at a discounted rate to keep those rates artificially low for a prolonged period of time. And it really didn't help because now we had hyper appreciation in a lot of markets. Some markets are now correcting from the hyper appreciation. So really the biggest mistake that buyers are making right now is just waiting for perfect condition. You never truly buy at the true bottom like that. You don't buy at that, right? Or you don't buy at the top. I mean, it will get there. And in this area is where most people end up buying. It will get here. And most people are kind of in this area, if you will. So they're kind of timing it. I get that, right? But perfect timing doesn't always exist. The best time for anybody to purchase a property isn't 5 years ago, as adage says either. The best time to purchase a property is when you're ready. So remember, perfect rates don't exist is another thing, right? They back and forth, back and forth, back and forth. And it's just how the markets are. Right now, more volatile than received. Knee jerks left and right because of all the things going on that we mentioned earlier. Perfect pricing doesn't exist. Most people buy because life happens. That's because things like marriage, kids, job changes, investments. We're looking to invest in property. I've written a book on building wealth through real estate. If you want to get a copy of that, please visit the link below. A lot of opportunities here. Long story short, a lot of opportunities. So if you're self-employed, an investor, or somebody who has been told that you don't qualify, please get a second opinion. Visit my link in the bio here. Check it, our stuff out. We have articles, blogs. I would love to help you if you have any questions. I'm here. Lending options today are dramatically different than they were even a few years ago. And it's not subprime crazy loans where you just have a pulse and you get a loan. No, we are qualifying clients' credit, down payment, ability to repay, right? But keep in mind, the market's changing faster than most people realize. And one thing I often say is, gosh, in 2010, when I was living in Sonoma County, you could buy a townhome by Sonoma State University in Roanoke Park, California for 110 to 125K. And at that point, they're renting out for 1,500 to 1,600 a month, mind you. I did it. I wish I did. So that's the other thing I'll leave you with. Hindsight could be 2020. So really, yes, the market just got a little bit more interesting. There is opportunity out there. If you're on the sidelines and contemplating what things look like, now's an opportune time to at least try to get started. There's a lot of opportunity out there. I'll leave you with that.